Even in the harshest winters, life does not vanish entirely. Beneath the frozen surface, there is motion, slow, unseen, but determined. After the worst of the crypto collapse, this was where the survivors turned their attention to enduring the cold, learning from it, and preparing for whatever season would come next. For governments and regulators, the lesson was clear. The digital asset market could no longer be left entirely to its own devices. In the European Union, lawmakers advanced the Markets in Crypto Assets (MiCA) framework, the most comprehensive regulatory package for cryptocurrencies yet attempted. It laid out licensing requirements for exchanges, reserve rules for stablecoins, and disclosure obligations for issuers. Across the Atlantic, U.S. regulators accelerated their own discussions, focusing on stablecoin oversight, anti-money laundering compliance, and the classification of certain tokens as securities. The goal was not to kill the market, but to impose guardrails, to prevent retail investors from falling into the same traps again. Industry leaders, too, began to adapt. Exchanges that had once grown in a frenzy of marketing and product launches shifted toward transparency measures. Proof of reserve audits, public wallet disclosures, and independent solvency reports. Some introduced emergency liquidity funds, intended to protect users in the event of another institutional failure. In DeFi, developers experimented with over-collateralized lending and algorithmic safeguards that could pause operations automatically in extreme volatility. For institutional investors, survival meant rethinking allocation. Funds that had once chased high yields through complex crypto derivatives now shifted toward lower-risk blockchain investments. Infrastructure plays, regulated custody services, and enterprise adoption projects. Venture capital, though slower, began focusing on companies building the foundational tools for the next phase of the digital economy, rather than speculative tokens. At the retail level, the transformation was quieter, but no less profound. Investors who had lived through the collapse began speaking openly about risk management, diversification, and the dangers of overexposure. Many adopted a cold wallet-first mindset, prioritizing personal custody over exchange balances. The term DYOR, do your own research, shifted from meme to mandate. Online communities reorganized around education, offering free resources on blockchain fundamentals, tokenomics, and market cycles. Academic circles saw renewed interest as well. Economists and data scientists began building more sophisticated on-chain analytics, capable of spotting concentration risks, whale activity, and liquidity shifts in real time. Research papers explored the potential integration of crypto with central bank digital currencies, CBDCs, speculating that a hybrid model could offer the benefits of decentralization without the wild volatility that had burned so many. Yet resilience was not only technical, it was psychological. The investors who remained had adjusted their expectations. No longer did they speak of tenfold returns in weeks. Instead, they discussed measured growth, long-term utility, and the slow process of rebuilding trust. The weather of wealth, once prone to sudden storms, seemed to settle into a muted, watchful season. The industry also confronted its own mythology. The collapse had exposed the gap between crypto's ideals and its reality. Decentralization compromised by centralized exchanges, transparency undermined by opaque accounting, community trust broken by leaders who proved fallible. To move forward, projects began emphasizing governance reforms. More on-chain voting, greater distribution of control, and the elimination of single points of failure. Regulators, developers, and investors were not always in agreement on how to proceed. Some warned that too much oversight would strangle innovation, while others argued that without oversight there could be no sustainable growth. But in the aftermath of winter, there was at least one consensus. The market could not simply return to the way it was. The excesses of the past had to be acknowledged if they were to be avoided in the future. Through it all, the blockchain ticked on. Blocks were mined, transactions validated, and networks upgraded. Ethereum completed its long-awaited shift to proof of stake, slashing its energy consumption by over 99%. Bitcoin's hash rate, after a brief dip, climbed to new highs as miners consolidated and adapted. These milestones did not erase the losses of winter, but they stood as proof that the core technology remained intact, a foundation on which something stronger could be built. In this period of rebuilding, the metaphor of the chessboard of capital seemed apartment pieces had been lost, strategies abandoned, but the game itself continued. The survivors played with greater care, knowing the risks, watching the board for moves that could signal opportunity or danger. And perhaps that was the greatest lesson of all, that in markets as in nature, seasons are inevitable. Winters cannot be avoided entirely, only endured. What matters is not whether spring will come. It always does. But who will be prepared to act when it does?